Hello and welcome to KYC. I am Sharad Dubey and with me is Mahima Vatsrajani, and today the company in KYC is Orkla. Interesting, and this also makes me a bit hungry. A lot of food items they have, right?
Yes, absolutely. A lot of packaged food items and spices is what they have.
All right, but let's see actually what we want to actually know about this company. The company was recently listed also, so of course the data will be limited. But there are some key questions, Mahima, which we will be asking. What's the geographical expansion? This is largely a south-based companies. What will be the margin guidance going ahead? That's also the second question I would be interested in. Apart from this, the sales mix, the guidance, that is also the street will be expecting what lies ahead. We have spoken about the company in the IPO time, but now what's the next leg? That's something we'll be looking at. GST impact and how they will actually go ahead, especially with the capacity utilization also kicking in. And lastly, the volume growth trajectory. A lot of questions for this company, but to decode it and revise it again for our audience, post the IPO, what does this company actually do? And I think that year 1996 has a significance.
Yes, absolutely. It does. It does. That's my birth year as well, but it was incorporated in 1996. Overall, if you take a look at what the company does, it gives a diverse range of food products. And this includes from your breakfast table to lunch to dinner, as well as snacks and beverages and desserts. Now, in terms of brands, it has, iconic Indian heritage brands. Everybody knows what MTR Foods is. Also, Eastern Condiments and Rasoi Magic. In terms of MTR Foods, it has instant mixes, ready-to-eat meals, masalas, breakfast mixes, snacks, beverages such as spices. There's RTC food, RT foods, vermicelli, etc. In the Eastern Condiments, it also has spices and convenience foods as well. In terms of where the geographical presence is, yes, more focused towards the southern markets, but serves across the countries. And this is, of course, on account of the quick commerce and e-commerce also picking up. The core markets for the company includes Karnataka, Kerala, Andhra Pradesh, as well as Telangana. And it also exports its products to about 42 countries. That includes your GCC countries, US, as well as Canada. In terms of SKUs, as of June 30th, 2025, it did have over 400 products across categories. In terms of manufacturing also, it manufactures goods across manufacturing facilities in India, has contract manufacturing facilities also in India, in UAE, Thailand, as well as Malaysia. And as of 31st of March, the company owns 9 manufacturing facilities in India, and total installed capacity is over 1,82,000 TPA. Now, in terms of distribution network, over that 800 plus distributors, and around over the 1800 odd sub distributors as well. So this is the overall brief about what the company is and what it does.
Well, that's pretty interesting on that, but let's just show our viewers what are the ratings which we'll be giving for the KYC, and of course looking at it, of course, income statement, operational metrics, balance sheet, cash flow. These are the important things which you'll be looking at. Apart from that, also shareholding street trade, which is nothing but your stock returns, how this has panned out, and also valuations. These will be the 8 important criteria where we'll be judging the company in KYC. But what will be the first parameter? Income statement?
Right, income statement. So if you take a look at how the company has done in the past, 3 odd years, this is the overall view of from FY23 to FY24. This is the reflection of FY24 to 25 numbers. But a 2-year CAGR stands at around 5% in terms of where the revenue growth stands. EBITDA growth of 2-year CAGR has been at 12%. Margins have improved for the company from a 14% to 16.5% in FY25. And profit after tax has grown at a CAGR of around 15 odd %. So in terms of where the top line is concerned, a 5% revenue CAGR, of course, this is also because the overall staple space has been impacted where the entire volume growth is concerned. But in terms of where the top line is concerned, just a 5% growth, and that's why we have taken a conservative approach here and given it a neutral rating. Also, if you take a look at the company's Q2 performance, in terms of the overall Q2 performance, it's done well. Revenue growth at that 4.9% mark. In terms of where the EBITDA stood, slightly down by about 3.3 odd %. Margins, however, has taken a hit in Q2, and this is something that we would want to know from the management as to why it was at 18.3% in Q2 FY25, and right now it is at a 16.9%. And what is the sustainable range of margin guidance? That is something that we would want to know from the management. PAT was down by about 7 odd %. So that's with regards to where the Q2 numbers stand. Now just a brief about the segmental performance also as to how the company did. In terms of spices, the volume grew by around 6 odd %. Deflationary pressure on key raw materials did continue, and convenience food revenue saw a growth of around 19.2 odd %. Sweets category grew by 26.4%. Digital commerce recorded a growth of 48.7%. Modern trade achieved 11.2% year-on-year growth. So I would want to know as to how digital commerce and modern trade is doing for the company. So this is the overall view of how income statement looks like for the company.
Well, so it's basically a neutral coming in, but Mahima, the operational metrics, there's a concern which was raised. Over here also you see that has actually also improved going ahead. 23, this was largely 1.8%, 1.5% coming in. FY25, it's 3.5%. Still, there's a question mark that when will the volume growth actually pick up? Is there a competition coming from the regional players, or there's a change in product mix? So entire question still remains for the company, and the data, the time period is still less. So I would be giving a thumbs down currently for the volume growth.
Okay, the next one is with regards to where the overall balance sheet is concerned. If you can take a look at the overall shareholding pattern, of course just got listed, so this is the pre-IPO equity shareholding that the company has. But over a period of time, the other equity, that is reserves and surplus for the company, has grown, slightly come down from the FY24 number, but still at a strong 2400 level. So not a bad bargain there. Borrowings, however, are zero for the company, so that's a plus point. No debt on the balance sheet in terms of where the long-term debt stands, except for some lease payments. But cash in bank has also grown at a steady state from a 75 crore to a 190 crore in FY25, and that is why we've given a thumbs up, because it looks like a healthy balance sheet. Well,
3 financial statements, 2 are already done. The next one is the cash flow segment, and over here you see the cash flow of operations. Post-listing, these numbers are looking strength. The H1 numbers are expected to be on the higher side also. And FY25 see the jump coming in for cash flow of operations. And if you compare that with the ratio, cash flow to PAT, that is also healthy, coming in at 99%, highest in the last 3 financial years. Net cash flows, that has also seen a significant up move. That means the liquidity ratios are decent right now. It will be interesting to see the working capital as well. But overall, from my side, it's a thumbs up when it comes to the cash flows.
Right. If we take a look at the return ratios, right, overall from a 3-year perspective, there was a slight dip where FY24 is concerned to that 20% mark, but still a 20% is a healthy return on capital employed ratio, but that did bounce back in FY25 to the levels of that 32%. So overall it looks like a strong performance where the return ratios are concerned. We don't have the ROE yet, but ROC has been on a strong footing, and a 32.7% is healthy, and that's why we've given it a thumbs up.
Well, that's a pretty interesting parameter which we took the company on. But shareholding pattern, not much, because the IPO had come in, there were exits from institutions. Promoters are still holding a healthy 75% stake in the company. This of course includes a large PVC investors in that. FIs under owned 3.6%. DI is also, the story is same. But the public, they are having a good chunk of that float, almost 17 odd %. So because of a lesser time zone coming in for this category, I would be giving a neutral rating, and I'll be looking at overall shareholding, how it actually pans out in the coming quarters.
With regards to where the street cred is concerned, since it's a very recently listed company, of course the IPO was the price was at 730. Since then, it's down by about 9 odd %. So not much of a performance there in terms of where the stock price is concerned. But it's also the markets, right? Markets have been volatile. Markets have not been rewarding IPOs recently. We've just seen a few IPOs like Grow or Physicswala that have done exceedingly well. But overall, the market sentiment is yet to turn very bullish when it comes to a lot of these IPOs that have come out recently. So keeping into consideration, this is a metric where we've given it a thumbs down, since it's down 9% since listing.
Well, yes, it's a very interesting, Mahima, the valuations front, and we are getting very confused when it comes to actually finding the actual peer for it, because the way Orkla is set up, this is into ready-to-eat foods. But Tata Consumer has some segments in it when it comes to the packaging also. But net, the closest peer which we could get was Tata Consumer. It was there in their RHP as well. The overall valuations, that's coming at almost 37 times. It's a trailing 12-month P numbers. Orkla doesn't have analyst coverage yet. Tata Consumer, that's 88 times. That's on the higher side. So net, to balance things out, I would be giving a neutral rating to this entire setup.
Right. So, Tata Consumer is not, a direct peer for sure, because Tata Consumer is also, in a variety of things. But close to what Orkla does, Tata Consumer also has a segment. And that's why we've just tried to compare it. And I mean, if you take a look at the valuations, Tata Consumer is very expensive in terms of a trailing 12-month stand. 36 times for Orkla is also not cheap, but cheaper than Tata Consumer, and that is why we've given it a neutral rating.
Well, that's pretty interesting, but let's revise all the ratings which we have given over the last 8 parameters. Income statement was largely neutral. Operational metrics largely pointed out on the negative side, but both balance sheet and cash flows, they have done really well, and that's why we have given thumbs up to it. Return ratios, decent performance, so we have given a strong up move. But shareholding and street cred, take it with a pinch of salt. This is a very short period of time where we have given the ratings, and of course the valuations, not direct comparison, but nevertheless a closest peer. But net, we have given roughly 4.5 out of 8, which is pretty decent as compared to what historically we give when it comes to the KYC ratings. But anything new and interesting you have read, you have tracked the sector and even this stock during the IPO. Yeah. Anything new and interesting from the company?
I think GST is going to give a lot of boost to these packaged foods companies. Plus, export has a lot of potential. So when we did the IPO, we also did a SWOT analysis, because if you take a look at the strengths for the company, there is strong brand royalty and market positioning that the company has. There's also high capital efficiency because the return ratios are very strong. Broad distribution and strong export business is also present for the company. In terms of where the weakness stands, it's more macro based, because raw material pricing at the end of the day will decide as to how their margins will move. Underutilized manufacturing facility is also a key concern, and that is something that we'll be asking the management as well, as to where their capacity utilizations are right now versus where they expect it to be. Opportunities, of course, expanding Indian packaged food market, and not just in India, but also the export side of things. Growth through innovation as to how they're trying to, innovate and bring more things into where packaged foods is concerned, more healthier things, which today's,
and Mahima, it's very interesting. We think it's a idli dosa batter is there, but they have spices also, export play. So that will be very interesting to see, how their export outlook goes ahead with. But joining us, we are having Sanjay Sharma. He's the Managing Director and CEO at Orkla India. A very good afternoon to you, Sanjay. First of all, we'll be asking you about your expansion plans. It's largely a south-based company, 4 important states in south where you have a significant presence. But now the expansion also comes in. Now you have IPO proceeds also. So how will you be applying that, and going ahead, which areas will you be expanding? Will it be the existing geographies, or are you looking something in west or north?
First, I think let me just clarify, it was an OFS, so we did not get any money. And the reason why we did an OFS was because we are a cash generating company. We've got enough growth capital coming into the balance sheet. You would see our balance sheet today has close to 350 crores of cash sitting out there. With regard to how do we see growth, I think for that you need to understand us a little better, because food in India is a very local subject. You know that Gujarati food is very different from the Maharashtrian food, and when you come to the 4 or 5 southern states, you actually see different cultures, different languages, and different foods. So you cannot classify South Indian food as one homogeneous set, because the food in Kerala is very different from the food in Karnataka. Given that, we do believe that the business of food is local. With that at the background, what we have done is we've built a portfolio of products that caters to the local culture, the culture of Karnataka and the cuisine of Karnataka very strongly, and similarly the cuisine of Kerala very strongly. So, what we believe as a growth strategy is really about growing deep in these states rather than growing shallow. Let me just highlight what does that mean. When we entered into India through the acquisition of MTR, we used to sell 16 rupees per person in the state of Karnataka. Today, we are selling about 110 rupees per person in the state of Karnataka. Now, what does this 110 rupees mean? Our largest selling SKUs are 100 gram sambar, which is 76 rupees for 100 grams, which means that today we are selling 120 grams of sambar to a person.
Right.
Now, it means that out of the 260 consumption occasions in a year that a person has, we are only selling to, 10 or 12 consumption occasions. So you
Right.
can see the scope for growth that we've got even in the local geography. So our business model is largely about building local brands and
Right.
going deep in our states.
Understood. Sanjay ji, Mahima also joining this side. Just want to get a sense with regards to your raw material pricing. How is that, how has that impacted the business this quarter? One thing. Secondly, your margin range was at that around 16% mark in FY25. Do you think that is a sustainable range of margin that you'll be looking at this year as well, and this quarter considering the GST impact as well?
I think, Mahima, you've really touched the right place as far as our business is concerned, right? Our business, as you know, 66% of our business is in spices and 33% of our business is in convenience food. Now, in spices, 60% of the market is still unorganized. That means only 40% of the market is organized. Now, given that fact, pricing to consumer becomes a very sensitive subject for us. Now, over the last 2 years, when you look at us, and I'm coming into this quarter as well, you'll see that the prices of spices has deflated 10% the previous year and another 12% this year. So it means that prices of spices over 2 years ago have deflated almost 24-25%. And this, of course, has impacted our top line growth, which you see as a 4.9% in this quarter. But that is also affected on account of other things. I will come and talk to you about that. Now, so our growths have been soft, but our volume growths have been extremely strong. So if you look at our volume growths, I think in FY25, you saw a volume growth of 3.5%. Last year, when you saw a volume growth, you saw, I mean, in the first quarter, when you saw, we had a volume growth of almost 8.5%.
Right.
And this quarter, we've delivered a volume growth of 7.7%. Now, if you have read the newspapers today, you will see that Nielsen came out with a report which talked about the whole FMCG sector's average volume growth at 5.4%. So
Absolutely.
we are outperforming the FMCG sector in terms
Right.
of volume growth at this point of time. Of
Right.
course, value growths are hit on account of commodity softness. And while the rest of the FMCG industry looks at inflation in most of the categories,
Right.
we have a 25% deflation or a 12% deflation over last year to deal with. So
Okay.
I think that is what is causing the softness. But I think if you look at where I stand from, business is developing in the right trajectory.
Right.
We've moved our top line up from 1.6 to 4.9.
Right.
If you remove the non-business impacts which have come onto the P&L, we are actually growing at about 6.8% with a volume growth of about 7.7%.
Fair enough. Mr. Sanjay, volumes. You talked about volumes, and we've seen that this year, FY26, there has been volume recovery in the entire space. You said you've already done that 7% mark. Do you think an early double digit is possible by the end of FY26?
Well, we are not allowed to give forward-looking statements, but I think we are moving in the right direction. And with the GST, which actually came in late last quarter, disrupted our business for about 8 to 10 days. We've still delivered a 7.7% growth. I think going ahead, you can certainly see that GST will have its effect. Consumption should improve. And I think that is a benefit that will come to all the FMCG and food companies.
So Sanjay, the export specific, I have a question, especially with the improving relations coming with India and US. A lot of your products, spices, which are exported abroad as well. It seems like some positive news flows is coming in this segment. So just give us the entire export outlook picture for the spices, and post the normalization of the relations which we are expecting with US, will we see a bump up in the overall spice exports?
Well, I think for exports, it's a new business for us. Okay. We had to, that we were part of, we acquired two companies, MTR and Eastern, to build our business. And then we merged the international businesses of both these things to create a dedicated entity as far as exports is concerned. Today, exports is about 21% of our business. And when you look at what we export, we are the largest branded spice exporter out of India for the last 24 years. Now, let me give you a composition of our export that we are doing. Almost 70% of our exports actually comes out of the Middle East, at the back of the brand, or at the back of Eastern brand, which that there is a Malayali from every household in Kerala in the Middle East. So Eastern is a very, very strong brand in the Middle East. And overall development in Middle East has been very strong this quarter. We have grown at about 14.5% in the Middle East. US just contributes roughly 3% of our total business, is a smaller part of exports. I think about 10 to 12% of our exports business comes out of United States. And we have, of course, there is a little bit of softening in terms of consumer demand in the US, but I don't see impact coming on account of tariffs as far as the business is concerned. So even if the tariffs get solved, I don't see that really affecting us in any particular way.
Sanjay, 21% of your total sales is exports right now, correct? Where does this
Yes.
go from here on? Let's say 2 years down the line. Do you think this share of exports will go higher and then your margins will improve?
Our margins are very good both in domestic and in international business. So it's not that
Okay.
international business leads the margin for us. So
Okay.
even if there is a salience change that is expected over a period of time, I think you will see that we are on a very strong margin delivery path at this point of time, and you would have seen that in our results.
And where is the blended capacity utilization at right now? What is it looking like, and any capex plans in near future?
Yeah. So I think if you look at our RHP, and I'm good because a lot of our data is out there, 9%, we've got 9 manufacturing facilities. We currently utilize only 46% of the capacity utilization. A reason for this is largely on account of the fact that this is the legacy that we adopted when we did acquisition of Eastern into the organization. At this point of time, I think our biggest challenge is to continue to build the capacity, build a few large, highly efficient factories supported by a network of satellite factories. We are outsourcing a lot of our products today. 11% of what we produce is outsourced. We expect that to go up. But from a capex point of view, I think having got the legacy of many units that have come into our fold, we don't really look at a very heavy capex requirement in the next 4 to 5 years. I think our capex requirements are not going to be greater than about 20 crores a year over the next few years. So it's really very, very minor capexes that we will require, largely to balance lines and do some food safety related initiatives.
And Sanjay ji, one last question is on health. Of course, ready-to-eat food is there, but what's the health part? We are hearing about jawar, bajra, ragi, so many things happening all around, and even tier 2, tier 1, both sides the interest is coming for the health segment. What are
Yeah.
the new product markets you are looking at to get into, or any other products are there in the offing?
Yeah, I think we largely operate in the traditional food space. So if you look at our portfolios, they reflect the Karnataka cuisine and the Kerala cuisine. Now you know that Indian food, if made at home and if you cook at home and you eat food home, is healthy, right? So, but having seen the trend amongst consumers to consume millets and other things, we are we had actually launched ragi dosa, multigrain dosa, oats idli very, very long time ago, about in 2015. But somehow what we see, at least in the traditional food space, it's that your ability to eat fresh food is more important than health at this point of time for the consumers.
That's pretty interesting. Fresh food over health food. Now that's a interesting take at every house. But another interesting take would be definitely what are the key takeaways coming in for our special segment KYC. And Mahima, first and foremost, the volume growth commentary that has been pretty decent for the company going ahead for, and also the margins front. The management is very confident when it comes to both domestic as well as your international segment, and that's something strength coming in our conversation. And look at this FMCG quarter which we have discussed, that was roughly 5% or something.
5% FMCG has grown
and they have
versus
gone
him growing
7%.
at 7%, yes.
So that is something which we'll be also watching out for, interesting data shared by the management. But net, the commentary remains strong as it's a recently listed IPO company as well. But this spice category deflation, that's also an important portion. 20 to 25% in 2 years. That's aiding the numbers as well. So pretty interesting for Orkla. But that's all for this KYC show. Stay tuned to NDTV Profit.